Hey there, Mad Money viewers. It's time to talk stocks. And today we're kicking things off with India. The Indian stock market is on fire, hitting new all-time highs last week. The NSE Nifty 50, one of their benchmark indices, surged past the 19,800 mark. We saw the S&P BSE Sensex, another major index, break records too. These gains are significant. They reflect a surge in investor confidence in the Indian economy. Remember, a rising tide lifts all boats, and this momentum could spill over into this week. What's driving this Indian bull market? Strong corporate earnings are a major factor. We're also seeing robust foreign investment flowing into the country. India's economic engine is firing on all cylinders, and investors are taking notice. But remember, what goes up can come down. We're watching for any signs of overheating. Keep an eye on inflation and interest rates. These factors could put a damper on the rally. This week, we'll be watching to see if these Indian indices can hold on to their gains. A close above these record levels would be a major bullish signal. It would tell us that the buyers are still in control, but a pullback could be in the cards. Don't panic if we see a little profit taking. That's normal after such a strong run. Now let's shift gears and talk about the Federal Reserve. Last week, the Fed cut interest rates by 25 basis points. This was a widely anticipated move. Investors had already priced it in. But that doesn't mean it won't have an impact on the markets. Lower interest rates tend to be bullish for stocks. They make it cheaper for companies to borrow money. This can lead to increased investment and economic growth. But the Fed also signaled that this might be the last rate cut for a while. They want to see how the economy responds before making any further moves. This cautious stance from the Fed is creating some uncertainty in the markets. Some investors are worried that the Fed might be taking its foot off the gas too soon. They fear that the global economy is slowing down. They argue that the Fed should be doing more to stimulate growth. Other investors are more optimistic. They believe that the economy is still strong. They argue that the Fed is right to be cautious. Now, let's bring in some technical analysis. The charts can provide valuable insights into market trends and potential turning points. When we look at the S&P 500, a key benchmark for the US stock market, we see that it's currently trading above its 50-day moving average. This is a bullish signal, suggesting that the short-term trend is up. However, we also see that the index is approaching a key resistance level around 4,500. This is a level where the market has struggled to break through in the past. If the S&P 500 can decisively break above 4,500, it would be a very bullish signal, opening the door for further gains. But if it fails to break through, we could see a pullback to the 50-day moving average. Another important technical indicator to watch is the Relative Strength Index, RSI. The RSI measures the strength of price movements and can help identify overbought or oversold conditions. The RSI for the S&P 500 is currently in neutral territory, suggesting that the market is not yet overbought. Now let's see what the experts are saying. Market analysts have a wide range of opinions on where the market is headed. Some analysts are bullish, citing the strong economy and corporate earnings. They believe that the market can continue to climb higher. Others are more cautious. They point to the risks of a trade war, slowing global growth and rising interest rates. It's important to remember that analysts don't always agree, and they don't always get it right. It's up to you to weigh the different viewpoints and make your own investment decisions. Don't just blindly follow the herd. Do your own research and invest in companies that you believe in. One important thing to keep in mind is that the market is forward-looking. It's not just about what's happening today, but what investors expect to happen in the future. If investors believe that the economy will weaken in the coming months, we could see a market correction, even if current economic data is still strong.